This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Welcome to our monthly bonus podcast about the world of investment trusts. I'm Dan Coatsworth, and this episode is all about stars. I'm talking star performers and stars and stripes. Joining me is Tom Sieber.
Hi, Dan. Yeah, we've got a really good selection of interviews and debates on this podcast, including a chat with the manager of Brunner Investment Trust, which has enjoyed one of its very best years in a long time.
And we're going to take a deep dive into Manchester and London, one of the best performing trusts this year. We're also going to look at ways to invest stateside, comparing the different US-focused investment trusts.
In addition to that, we're going to talk to a fund manager from Columbia Threadneedle's Global Smaller Companies Trust, which does exactly what it says on the tin. It looks around the world for the best opportunities in the smaller company space. But first up, let's kick things off with Brunner, one of the best performers in the AIC's global sector this year. Dan talked to one of the managers over Zoom a few days ago, and this is what he had to say.
So I'm delighted to be joined by Julian Bishop from the Brunner Investment Trust. So Julian, thanks ever so much for coming onto the podcast.
No, hi, it's great to be here.
Brunner's delivered nearly 40% share price return over the last 12 months. I mean, that's really, really good. What's been driving that performance? And I was just wondering whether a lot of those gains have actually just come from the trust moving from a discount to premium.
That's certainly been part of it. So it's quite easy to separate. So as listeners probably know, and people who are interested in the investment trust world know, investment trusts, the price of them is set by supply and demand. So they can trade at a premium or a discount to the value of the assets that are held in the trust. And it so happens a year ago that the discount was unusually wide. It was about 15%. And over the last year, we've gradually managed to narrow that down. We're actually trading now at a modest premium. So over the last 12 months, of that 40% return, about 16% has come from that sort of narrowing of the discount to emerge at a small premium. The rest of it has been from growth in the underlying NAV. So that's the value of all the shares that we hold, which is a good performance. I think if you look at global equities over the last year, the US in particular has had a very, very strong period. So overall outcomes for global equity investors have been pretty decent, and ours just happens to have been augmented by that narrowing of the discount as well.
I mean, probably quite good if you could sort of explain exactly what the trust's investment strategy is.
Yeah, sure. So that's a big question. You know, how long is a piece of string? But just to give a very sort of brief introduction to the trust. So we're a combination of global and UK equities. So we have quite an unusual benchmark. It's 70% global, 30% UK. And the idea there really is that we have lots of exposure to the terrific value and dividends and cash cows that are listed in the UK, plus plentiful exposure to all the world-class quality and growth, for example, in the US tech sector. We have a dual mandate. So one is to provide a growing dividend every year, and one is to provide growth in capital. So, on the dividend, for example, we are listed, named by the AIC as a dividend hero. We've grown the dividend of the trust each year for over 50 consecutive years, which is an incredible record dating back to the early 70s. And then the investment philosophy in terms of how we select our equities, we call it an all-weather approach. So really it's a balance between quality, value, and growth. So it's not ideologically driven. We're pretty pragmatic. Where we are depends very much upon market conditions and the situation as we see fit. So some investors, some fund managers describe themselves as value investors, some as growth investors. We basically don't think that makes sense. It's all very well to say you're a growth investor, but there has to be some reference to value. So we always say we want as much growth as possible, we want as much quality as possible, and we want as much value as possible. And for each of our equities that we hold, it's our job to sort of triangulate between those three often mutually exclusive factors. What we are always resolutely focused on is cash. So the cash returns that our companies can return to shareholders over the long term is really what we're thinking about. So we want as much cash as possible. We want it to grow as much as possible. And we want it to be as low risk or as reliable as possible. So, we think that's a pretty timeless way of running money. It's, heavily influenced by the likes of, Warren Buffett and Charlie Munger. And we think it strikes a good balance between prudency and opportunism. And I think that's vital. We have to, on the one hand, protect our shareholders from the madness of crowds where, froth starts to emerge. But on the other hand, we need to be very attuned to the fact that, particularly in the US, particularly in the tech sector, we have seen the emergence of these extraordinary companies that have generated lots of value for shareholders. And we want to make sure that we have a process that is capable of owning those too. So, for us, it's all about balance, and it's worked well for shareholders. So, over the last 5 financial years, we've managed to outperform, which is a very unusual track record. Although, full disclosure, we're a bit behind this year, so we're unlikely to make it 6 in a row, unfortunately. But ultimately, trying to be a one-stop shop for any long-term equity investor who wants something at the core of their portfolio.
I mean, you mentioned about the concept of sort of an all-weather approach. I mean, does that sort of imply that Brunner might deliver positive returns in all market conditions, or is it, should people not expect that to always happen?
I think it's a bit of a stretch for any equity portfolio to say that you'll be up in, every year. I think, we know the history of equity markets, and there are years where you get profit recessions where maybe markets derate because of some sort of fear factor. So I think it's always a stretch to say that any equity portfolio, core or not, will go up every year. And I certainly wouldn't expect a repeat of last year's 40% performance. What we say is that we think we stand as good a chance as anyone of outperforming. We've got a good record of doing so, and particularly over a long time frame, you can see that those returns have compounded quite nicely. So over 5-10 years, we're well ahead of benchmark as we've gradually eked out outperformance. But I always think it's a stretch to say that in any one year an equity fund will not go down. It's always possible. But over the long term, if you look at what drives equity returns over the long term, it is always a combination of 2 key things, which is the cash that the investment companies deliver to you, and then it's the growth in earnings per share. And we have a bunch of companies in our portfolio which generate lots of cash, and they tend to return that cash or deploy it in other value creative ways. Most of our companies we think should grow with reasonable reliability. So over the long term, we're always thinking about how we can get to a sort of low double-digit return for each of our investments. And if you look at the growth in NAV of the trust over the last 10 years, it's delivered about 11% growth per annum. Now, in the shorter term, you can get valuation fluctuations and you get profit recessions, etc., and that can cause a down year. So we tend to shy away from making any sort of forecasts about what might happen in the next year. But over the long term, we're set up to deliver a good return for our shareholders, driven by the return of cash and growth in earnings.
I think a lot of investors might expect global equity funds to sort of be led by large positions in sort of this magnificent 7 group of sort of mega cap tech stocks like Nvidia and Apple and Amazon. But you seem to have low exposure to these sort of magnificent 7 names. So why aren't you sort of all in on those stocks?
I mean, they're all exceptional companies. I think the whole sort of Mag 7, with the possible exception of Tesla, which is in the auto space, which is very, very competitive, a lot more difficult. But they're all great companies. Our largest position actually happens to be Microsoft, which is one of the Mag 7 names. That's equity that's really at the core of the portfolio. We've also got a position in Google. These are the ones, these 7, just by dint of their size, get a huge amount of attention. But there are other tech stocks. There are maybe a bit smaller that have done equally well, and we have had reasonable exposure there. So one of our biggest contributors to performance for example, over the last year has been Taiwan Semiconductor. So this is what's called a semiconductor foundry. So it actually manufactures, it actually makes these semiconductors. And they have extraordinarily high market share making the most very advanced semiconductors. So they have over 90% market share making these sort of bleeding edge chips that are used, for example, by Apple. So Apple design their own chips. So the chip in your iPhone is actually one of the most sophisticated chips there is in existence. They will all be manufactured by Taiwan Semi. Ditto, NVIDIA makes, graphics processing units, GPUs for AI applications, been an extraordinary stock over the last year. They don't actually make chips. They design them, and then they're made by Taiwan Semi. So that's one of our core holdings, and that's doubled over the last year. So we've managed more or less to keep up, despite being a little bit underweight those Magnificent Seven names. Those Magnificent Seven. Actually, if you look over the last year, they're all very different businesses. The range of outcomes has been very, very varied. So NVIDIA is the one that's blown the lights out over the last year. Things like Apple and Tesla have actually been pretty humdrum over the last year. Where we own them, we just see great combination of quality, value, and growth. That's what we're always looking for. Things like Apple, which we have owned in the past, for example, just at the moment, struggling to grow. The smartphone market, which is still the core of their business, is pretty saturated. And for us, the multiple just looks a little bit high given their growth rate. But I would concede that Apple is one of the world's great companies, and certainly wouldn't rule out owning it again in the future.
Yeah, I mean, so Taiwan Semiconductor, I think some people know it as TSMC. I did notice in your recent commentary for the trust that you actually been trimming position in that, and also Novo-Nordisk as well, so the link to the weight loss drugs. So obviously those two companies, again, sort of names you would expect in a global equity portfolio. But why have you been sort of slowly selling little bits of those?
So with Taiwan Semi, it was a pretty small sale. It was just risk management, really. I mean, the stock's doubled, and we'd run with it. It had grown to be about a 4% position in the fund, which is sort of right up towards the upper end of our position sizing. So we just saw it fit to take a little bit of profit there, but that remains a core holding. Novo-Nordisk. So this is the Danish pharmaceutical company that gets a lot of press because it's the leader alongside Eli Lilly in the States, making weight loss drugs. And there we've actually now exited the position entirely. And that's been a big position for us for a very long time, very successful. The reason we sold it there is the one issue with pharma companies is they don't really exist in a sort of free market economy. So what happens is if you're a drug company and you discover a new molecule with useful medical benefits, you get a patent on that molecule that lasts a finite length of time. So you basically get a monopoly selling that drug for a finite length of time. And then at the end of that period, it's called going generic. So you get this loss of exclusivity. And at that point in time, competition floods in. Anyone can make the drug, and the profit is massively eroded. So this is a long-standing feature of the pharma sector. Our concern with Novo-Nordisk is all its recent success really comes from this one molecule, which is used to make drugs for both weight loss and for diabetes. To the extent now that about 75% of their sales are one molecule, and that molecule goes off patent in 2031. So it's only 7 years. So remember, we're always very focused on the long term. So we think they have a great 7 years ahead of them, incredibly profitable, great growth. We think these weight loss drugs are incredibly effective, and there's about 200 other medical conditions that are associated with obesity. So, the benefits of this drug are incredible. But then what happens at the end of the 7 year period is really unclear to us, and we think that profits will probably take a big step down. So there's a huge amount of dependence on a new drug they have in their pipeline called CagriSema, which we think had made the investment case very, very binary. So if that drug is a success in its trials, Novo will probably do quite well. If it isn't a success, Novo's share price will be, I think, really, really, really weak. We don't like binary outcomes. We want we're all about hitting ones and twos, sure things, lower risk equities. So the investment case for Novo-Nordisk has sort of drifted away from the type of stock that we want to invest in. So we decided to take profits and move on.
I mean, that's really interesting. But where have you sort of been recycling the proceeds then? Is it sort of new positions or buying more of what you already own?
Bit of both. So, I mean, to highlight two new positions and maybe give you a sort of idea of the type of equities that we like, which are perhaps not as prominent as some of the ones you typically see in a global equity portfolio. Because one of the benefits of being global is we can go anywhere in the world, and because of our reasonably pragmatic approach, we can invest in all different types of businesses. So one we've invested in recently, which will be very familiar to people in the UK, is Auto Trader. So if you've ever bought a second-hand vehicle, the odds-on chance are that you use the Auto Trader website to do part of your research. Most people who buy a car in the UK do so. Believe it or not, Auto Trader is actually one of the world's greatest businesses. It's got operating margins of 70%, 70, which is amongst the highest of any business of scale in the world. The invested capital, the amount it actually costs to build Auto Trader was negligible. And they just have extraordinarily high market share. So their business model is they get paid by all the auto dealers. So anyone who wants to list their inventory on Auto Trader has to pay to do so. Because Auto Trader has such high sort of share of eyeballs for anyone doing research, it's unthinkable that any second-hand car dealer would not list their inventory on Auto Trader. It's just a cost of doing business for them. Quite often it's their entire marketing budget. So it's just a terrific business, incredible pricing power and ability to offer dealers sort of new functions that allow them to attract customers better. And the valuation there pulled back to what we thought was a very reasonable level. It generates lots of cash. It returns it all to shareholders because it's got nothing else to do with it. So a great cash flow stream that is growing. We think very reliable, not really subject to economic cycles. A risk that's probably uncorrelated to most of the things out there. So exactly our kind of equity. So, good high starting free cash flow yield of about 5%, which we think will grow, every year, 5 to 10%. Lower risk than most equities, we think, because of their market position. They're not subject to competition in the way that many businesses are. So we love that one. And then more prosaically, we bought an insurance company in the United States called American Financial Group. So just a very plain vanilla property and casualty insurer that will insure businesses. Great record of eking out modest growth, very generous dividends. So it's got almost a 7% dividend yield. It's based in Cincinnati, Ohio, very folksy management. So like on their quarterly earnings calls, they'll thank God in the United States of America, it's very sort of Warren Buffett. I always figure out Berkshire Hathaway, has an insurance business at its heart that just generates lots of cash. And I think that's the lesson that we have sort of taken to heart at Brunner as well. So, it's a less glamorous business, slightly off-piste. We think at the moment it's very important to be a bit more disciplined on valuation because all these glamour stocks now trade at very high multiples. And so we recycled some of the capital from Novo-Nordisk, which has become a very richly valued stock, which is doing very, very well at the moment, which has an uncertain future. We've recycled it into this far sort of more mundane cash cow. And that's what Brunner's about, really. There's this ability to switch styles, if you like, and switch gears depending on market conditions. And we are sort of conscious at the moment that, for example, the US market, the more glamorous end, the Mag 7, has had an extraordinary year, big re-rating in the shares there. To our mind, valuations in some instances drifting into uncomfortable territory. So it's our job to, protect our clients against multiples which don't leave room for a good return in the years to come, and to put it into some things that are a bit more mundane, a bit less glamorous, a bit more prosaic, but we think have a good chance of delivering a decent IRR in the years to come.
So I guess the final question is, as we sort of move into 2025, what's your sort of confidence levels like as an investor? You feeling quite upbeat about making good returns next year, or think actually it could be a bit more challenging?
I think, I'd always sort of drag people back to thinking about the long term. So, we want Brunner to be the sort of core core holdings. We have, lots of retail holders on AJ Bell who I think have us as their long-term sort of core global equities investments. Always very hard to say what will happen in a single year. I'd say there's been a huge divergence over the last 12 months between what's happened in the United States and what's happened in Europe. So, excitement about the US market probably as high as ever. Extraordinary companies listed there, so it's partially justified. And people who've, rang the bell on US valuations before have repeatedly been shown to be crying wolf. But I do think it's something we need to bear in mind there. In the UK and Europe, valuations are really, I think, compelling levels. So it's a bit of a mixed bag. We have a balance between all those different markets. I'm certainly not nervous. I think over the long term, equity is still a great place to be, driven by cash returns, profit growth. And I look at our portfolio and I think, we've got a great bunch of great businesses that generate a lot of cash, should grow. And I think over the long term, that leads to decent outcomes. At the margin, we're making some adjustments, maybe recycling some money from areas where we think valuations have become a bit rich and into slightly more value oriented names. So my expectations for 2025, I think it'll be okay, but not a repeat of the big bull market we've seen in 2025. A lot of which, by the way, was driven by multiple expansion and a re-rating in the US particularly.
Yeah. Well, Julian, thank you ever so much for joining us on the podcast. It's been really good to have you on the show.
No, thank you very much. It's been a real pleasure.
Brunner does come across as a bit different to your average global fund or investment trust. So it was great to hear what the manager has been up to.
So sticking in the global sector, we've had a few requests to talk about Manchester London because like Brunner, it too has had a great year in terms of performance. Now, despite these strong returns, it's not actually that well known a trust among retail investors, partially because it's not run by one of the big asset management companies and it doesn't really do a lot to market the trust. So that actually makes it a perfect thing to explore in more detail on this podcast. So let's bring on Steve Frazer from Shares Magazine to tell us a little bit more.
Today, we're talking about one of the best performing investment trusts so far in 2024. It's called Manchester and London, and its shares are up nearly 40% year to date, with a net asset value total return of around 50%. Now, this is a relative minnow in the trust space, and it has a real clear focus on technology.
So Tom, who's looking after this trust? Who runs it?
Yeah, so I'll maybe do a little bit of a potted history of it. I won't go into too much detail because it's not hugely relevant to what the trust is today. But it was set up by a guy called Brian Shepherd, who's the father of the current manager, Mark Shepherd, in the early 1970s. And then it had a decade as a sort of quoted investment trust before there was a kind of complex series of deals in the early 80s, which resulted in it leaving the stock market. The Shepherd family acquired a controlling interest in it of upwards of 70%. The next 15 years saw it pursue a pretty concentrated investment strategy, often investing the vast majority of the portfolio in just a few shares. And that's something that's continued, which we'll discuss in a bit more depth later on. And it's sort of interesting to know that the Shepherd family still have around 50% of the trust, which relisted on the stock market in 1997.
So that's sort of background to it, but it does seem to have changed its spots to some degree, Tom. Why don't you give some background on that?
Yeah, absolutely. So like I said, the guy steering it is Mark Shepherd, and he's been doing that with a guy called Richard Morgan over the last 10 years. And them taking over the sort of control or kind of steering the ship in terms of this trust also coincided with a shift in strategy to focus on technology. Both managers notably have computer science degrees, so they've got a background in that area. And the trust's central investment thesis, and I quote, is that they believe in the increasing economic power of the machine. And for Machine, that really has translated into a big focus on AI, which obviously has sort of chimed pretty well with what has been one of the best performing themes in recent times.
It does sound rather Big Brotherish. Focus on
It does.
machine.
It certainly does. Yeah, it's a bit Orwellian, isn't it? Really, but yeah, that's how they sell it. And I mean, this isn't a sort of strategy that has been without criticism in the past. So there's a couple of things that have been thrown at it. There was some negative commentary from brokers, Investec. So their analysts were quite critical. This is going back a couple of years, suggesting that the stock had underperformed the sort of tech rally in 2021 coming out of the pandemic, and then been overly exposed to the subsequent sell-off. But if you look at its performance on a longer term view, it is pretty impressive. That's largely thanks to the company's exposure to the really big tech companies that have been leaving the market over the last 2.5 years. So
Amazing, Tom. I mean, they really have gone on overweight on a couple of stocks. Why don't you tell us how overweight they are?
yeah, exactly. So they've really gone all in. You're right. So Nvidia, according to the Trust latest fact sheet, has a weighting that is nearly at 40%. And you throw in Microsoft.
Tom, do you mind to say that again? Because I'm not sure our listeners will fully appreciate that.
Yeah,
that's nearly
not
40% of the
14,
portfolio.
Yeah, 40% is Nvidia. And then you throw in Microsoft, which is the second largest holding, and you've got two stocks making up 60% of the portfolio. I mean, to give the trust some credit and the managers some credit, it's not that they bought into Nvidia kind of, you know, they've joined the party late and they've just kind of jumped on the bandwagon. They've owned it, from what I could tell, looking at a kind of historic annual report since 2017. So
they've captured, because I mean that's not long after Scottish Mortgage. You tend to pick up on these themes pretty early. I think they first invested in Nvidia in 2016, so that might suggest that Manchester and London have been pretty savvy in terms of looking ahead and making some very clever predictions.
Absolutely, yeah. So I mean, they've captured a lot of the kind of pretty astonishing rise we've seen in Nvidia since then. So yeah, so I mean, you know, the criticism I suppose they got for performance is kind of, it's harder to stand up. Looking at sort of how they've done, you know, even kind of they've done well obviously over the last year, which is why we're talking about it, but also over sort of longer time frames as well. The performance is pretty impressive, pretty much since, you know, a decade ago when they made this shift into technology.
I mean,
sorry, go on.
So just to interrupt, but I mean, I suppose from a listener's point of view, an investor's point of view, this really is then a really geared bet to particularly a couple of very popular AI-led tech stocks. Now, there's a million ways you can get market-weighted exposure. Buy an ETF for the S&P 500, for example, and you'll get market weightings of these two companies. But if you want to overexpose yourself, but still within the fund structure, then this seems to be one of a handful of funds that will allow you to really overweight yourself to these two particular stocks.
Yeah, I mean, you can't accuse these two of a lack of conviction, or kind of, you know, you can't suggest that you'd just be as well buying a passive instrument, because yeah, undoubtedly they've made you know, a really big bet on these two stocks. So yes, that's a really good point. The other criticism that Investec made, and I've seen sort of made elsewhere, is the benchmark that they use. And I mean, it might not matter too much to people, you know, they might just look at the absolute performance, but you know, obviously a benchmark is intended to give you an idea of the sort of relative performance of a fund or trust. And they use the MSCI UK Investable Market Index. But from what I could tell from the latest fact sheet, you've got just over 6% of the portfolio in the UK and EU. So given the UK market has underperformed the US market anyway, and that the vast majority of the portfolio is in US stocks, it does sort of feel like that using that benchmark is going to paint relative performance in a very flattering light. Their justification for it is that basically UK investors will understand the domestic benchmark better. I'm not sure.
That
I
sounds a
think
bit changed, isn't it?
yeah, exactly. And then also that they've used this benchmark since they relisted in 1997, and that at times they have had an entirely UK listed portfolio, and they say theoretically it's possible in 20 years' time every stock in the portfolio will be UK listed. But if you read their recent fact sheet, the commentary that accompanies it suggests that Europe's economy, to most logical observers, is clearly doomed. So it doesn't suggest they're likely to be piling into UK stocks over the next 20 years. So that does seem like a fair criticism, I guess.
Yeah, I mean, I always think that, I mean, if you've got a very specific and quite niche investment strategy, you may be better off focusing on sort of a more general benchmark and say, look, if you just had shares, global shares, this is how much we've beaten that index by our geared specific niche strategy. And it's the kind of view that for example, Scottish Mortgage take. They have a very generic kind of benchmark. It sounds a much more sensible way to measure yourself. Or you go down a route of saying, well, we'll measure ourselves against the information and technology indexes, Dow Jones 1 or the FTSE 1 or something like that, which is what things like Polar Capital Global Technology do. So it does seem that they're almost causing a problem by just being so specific to this benchmark, which doesn't really seem to have any great meaning.
Yeah, no, I think that's fair. I think it's like you said. I mean, they do talk about their performance in the sort of surrounding commentary in relation to things like the Nasdaq 100, which would seem a much more logical kind of benchmark in some ways. In terms of some other details on the trust, so it trades at a rough 18% discount to net asset value, which is fairly wide. It's one of the wider ones in the global sector, which is where sort of the Association of Investment Companies, the investment trust body, puts it. For comparison, we mentioned Scottish Mortgage earlier. That trades at around a 10% discount, and I think it's been a point of discussion that discount has widened more recently at Scottish Mortgage. So it does trade on a pretty wide discount. The ongoing charges, they guide for ongoing charges of 0.9% in 2025. That's higher than most of it.
Sounds fairly full, doesn't it?
Yeah. I mean, not outrageously so, but it's obviously a bit higher than some of its peer group, probably reflecting the fact that it's a bit smaller in terms of assets. So yeah, I mean, it's an interesting approach, and like you said, we have to give them some credit for being quite early to a story like Nvidia, and they're very, very. If you look at sort of when the managers have been interviewed, or they've kind of the commentary that they put out alongside their performance and their fact sheets, they are very committed to this idea of the AI theme and how transformative it's going to be. And their take is that we're still in quite early stages of this, and if you buy that argument, I guess maybe being in Microsoft and Nvidia is not an unsensible strategy. But
I mean, it strikes me, Tom. I mean, I like technology for obvious reasons, and I'm a big fan of the growth potential there. But I'm just looking through, the rest of their top 15 or so holdings, and it's almost exclusively technology names. So Advanced Micro Devices, Alphabet, Arista Networks, Broadcom, ASML. I mean, the list goes on. It's very, very tech focused, and I think that's something that investors should be aware of. They're not really getting, even aside from the weightings issue, they're not getting a broad portfolio here. This is very specifically tech. Now, that might change. If it was me, if I own shares in this investment trust, I'd be looking for what are they going to do with that Nvidia stake? Are we looking at maybe starting to sell down some of the holding, given Nvidia's trading at nearly all-time highs? So I'd be looking for news over 2025, I think, and see how that portfolio might get reshaped going forward.
Yeah, I mean, to sort of answer that point slightly, I have seen the lead manager interviewed, and he suggested that actually they don't want to dilute their exposure. So that could change. Obviously, I'm sure they're capable of changing their minds if circumstances dictate. But for the time being, it looks like they're comfortable with that sort of what is quite an unusual situation of having two stocks representing sort of 60% of the portfolio.
Thanks to Steve Frazer for joining us to talk about Manchester and London. Right, the US election is out of the way. A lot of people have now asked us how can they get exposure to North America via investment trusts. So your wish is our command. Here's Martin, Gamble and Ian Conway to run through the different options in the investment trust world.
So Martin, this afternoon we're talking about US trusts. We're looking at 6 trusts, all of which can be found on the AIC website. That's the Association of Investment Companies. We've got 2 large cap growth trusts, Bailey Gifford US Growth and JP Morgan American. We've got 2 income focused trusts, BlackRock American Income and North American Income, which is run by Janice Henderson. And we've got 2 smaller company trusts, Brown Advisory US Smaller Companies and JP Morgan US Smaller Companies. Quite a range of market caps and returns over the periods that we're looking at. And I'm guessing, just had a brief look at some of the sort of top holdings of some of these trusts. Quite a different approach to markets. So, funnily enough, at the smaller end of the scale in terms of size of assets, is obviously one of the smaller companies trusts, which is Brown Advisory US and BlackRock American Income, both around the sort of 150 to 200 million pound mark. And one is on a discount. Brown Advisory is on a discount of 6.6% to NAV. That's as of today's date, and we're recording this on Tuesday the 19th of November. And BlackRock American's on a discount of just shy of 10%. And it looks to me as though that might actually be the sort of weakest performer over 1, 3 and 5 years. I don't know if that total is what you've got.
Yeah, that looks about right. Yeah. But there are two interesting approaches to the markets. I mean, Brown Advisory, probably not as well known as some of the other names, but it's a large organization. And they've got some experienced managers managing the US smaller companies. Chris Berrier, George Sakalanis, I think he's called. They approach it in a way that they're looking for high quality businesses with sound management teams and competitive advantages. I guess a lot of managers say that, and they're looking for above average growth. But they specifically identify what they call the 3 Gs. So they're looking for durable growth. They're looking for a long runway of growth in a particular sector or industry that the company operates in. They're looking for good corporate governance. So that's a diverse board, aligned management incentives, director incentives. And the 3rd G, they're looking for a scalable go-to-market strategy. So that means that they're looking for companies where if they do scale up from 10 to 1,000 to 1 million, etc., they can handle it as a business and it's actually properly scalable. So they're the kind of opportunities
they've got the capacity to grow. Yeah.
Yeah. And the other thing they sort of talk about a lot is that they've got a deep kind of network of different areas of interest in the company itself. So they've got venture capital, they've got private equity. So they say that gives them an informational advantage and it gives them an edge perhaps over some of the other companies operating in the space. And as you say, the performance has been pretty decent, I would say. They've underperformed the benchmark. They use the Russell 2000, which is the small cap benchmark in the US. They've underperformed over 5 years, but they've done better over 10 years. They've outperformed the index over a longer period. And over 1 year, 23%. It's not too bad, is it? Sort of names they own.
No, not shabby at all.
Yeah, sort of names they own. Most people wouldn't have heard of, so I don't think there's any point in kind of mentioning them. But it's fairly broad, I would say, across very different sectors. And they have analysts that operate they specialize in these different areas of the market. And they come up with their best ideas and they screen out a lot of the cyclicality. They don't like cyclical companies. And, to sort of get that 2,000 company universe down to a manageable size, but they have specialists that just give their best ideas within their specialist areas. And those names sometimes get into the portfolio, I think. So it's a low turnover, sort of a long-term approach. So yeah, it's an interesting way to get to some of the companies that are operating in the US, which probably most people not heard of.
Yeah. And then, as I say, we were looking at BlackRock American Income. I mean, that, again, quite a small trust, but it does own stocks everybody will be familiar with. Citigroup's the biggest holding. Got a reasonable weighting in healthcare, Cardinal Health, CVS Health, Sanofi, then the French stock Sanofi, it must be the ADR, I'm guessing. Kraft Heinz, again, pretty well known. But they're measured against they're an income fund, but they're measuring themselves against the Russell 1000. Is that right?
I think that's right, yeah. So that's, I guess, the larger end of the small cap index, because they need companies that are already producing an income and they're looking for that to grow in the future. So they're looking for established companies and sort of staying away from the smaller end of the Russell 2000. But again, yeah, they've done reasonably well. They've underperformed over 5 years, but they've outperformed over 10 years. As you said, they've got a lot of exposure to healthcare. That's one of the overweight sectors, as is IT, consumer healthcare. Sorry, discretionary names as well they like. So, yeah, that trades at a 10% discount.
Yeah, absolutely. Interestingly, actually, North American Income, which is the other income trust we were talking about, 500 million of assets. That's on a 10% discount as well. And that also has a reasonable weighting in things like financials and healthcare. Top stocks are Merck, the drug maker, Medtronic, MetLife, the insurer, Citigroup. So there's kind of, and in fact, hasn't performed that differently. Looking at it over sort of 5 years and 10 years, it actually has performed kind of in line with BlackRock American Income. So similar stocks, I guess you would imagine that they'd end up with a similar performance. And they're also measured against the Russell 1000.
Yeah. And isn't that been recently taken over by Janice Henderson as the manager, I think, in August? So whether that track record reflects the lead manager's prior track record or whether that is the prior manager's track record, I'm not sure. But Jeremiah Buckley is the current manager. So I'm guessing that's his track record, which is okay over the very long term.
Yeah.
I was reading his latest comments on his monthly fact sheet, actually. And he's very optimistic about economic growth, and he thinks that falling interest rates will be good for trusts that provide income, because dividends will be valued more highly when bond yields are falling for investors looking for income. So that was an interesting point he made. But equally interesting was that he said in some sectors that he looks at, the valuations concern him a little bit. Now we know that the Mag 7 and the larger cap names in the US trading at pretty close to all-time high valuations, depending on which measures you choose. So it's interesting that as an income manager looking at a slightly smaller companies, that he also notes some valuation concerns.
That is interesting, isn't it?
Yeah.
Well, that brings us to the last two, the sort of big cap, growthy,
the big boys,
growthy trusts. Yeah, the big boys. So Baillie Gifford US Growth, just shy of £800 million of assets, and JP Morgan American is £2 billion of assets. I mean, there's clear blue water between these guys. JP Morgan American, by far the better performer over the long term. And I guess when you look at the makeup of the portfolio, Microsoft, Amazon, Nvidia, Meta, Apple are your top 5, followed by Berkshire Hathaway. It kind of writes its own story there, really, doesn't it?
It does, yeah. And in fact, that's one of the only trusts that we're looking at today that trades at NAV or close to slight premium discount, depending which day you look at it. So I think that reflects the performance and the scale of this trust. It's high conviction stock picking approach, looking at quality businesses, strong balance sheets, strong managements. But yeah, those names, Microsoft, Amazon, Nvidia, Meta, Apple, Berkshire, very interesting names. And one recent name that they added to the portfolio was McDonald's, which, when you hear all these stories about the US consumer struggling with high inflation, it's an interesting purchase. And also in the light that Berkshire Hathaway, which is one of their holdings, recently announced a 3.7% stake in Domino's Pizza. So there's something going on in consumer discretionary for these managers that perhaps other people haven't recognized.
Now, that's interesting because we turn lastly to Baillie Gifford US growth. I mean, this stands out because it stands out to me because a third of the portfolio is in unlisted stocks. Very Baillie Gifford, very like Scottish Mortgage, strong focus on unlisted companies. So these include things like payments companies Stripe, SpaceX. But when you get away from that, sure, they own Nvidia, they own Amazon, they own Meta. But going back to your point about consumer names, Shopify and DoorDash are in their top holdings.
Yeah, that is a bit more surprising, isn't it? Given it's very competitive, that delivery business. So to see that in one of the top holdings is interesting. And they've suffered, haven't they? Because of the listed, roughly a third of their holdings are unlisted. There's been a lot of skepticism since rates went up, and there's been concerns about the valuations of those companies. And I think Baillie Gifford themselves say that the performance of the underlying companies they own in the private sectors are actually performing very well. But obviously, investors don't see that day to day, so they have to rely on the trust that, the valuations are the valuations. But I think that's been a real drag on the shares over the last couple of years, really. But yeah, that's a truly Baillie Gifford. They do stand out because they're looking for companies with the potential to grow substantially faster than the average company, and they take a very patient, very long-term approach. They don't ignore valuations, but they just are very patient about the way that they expect that value to come through the share price over time. So that really makes them stand out.
Thanks very much to my colleagues Martin Gamble and Ian Conway for talking about the different investment trusts putting money into US listed stocks.
So we've got time for one more segment, and it's widening the net in terms of where the fund manager looks. So rather than restricting to one geography, Nish Patel looks around the world for opportunities, and he actually focuses on the smaller company space. So Nish works for Columbia Threadneedle and manages the Global Smaller Companies Trust. Tom recently caught up with Nish, and this is what he had to say.
I guess this trust has a bit of an enviable quality, and the name tells you a fair bit about the role that it plays, which is not always the case in this industry. But could you explain in a bit more detail what the strategy behind the trust is?
Yeah, absolutely, Tom. So the Global Smaller Companies Trust is an investment trust that invests in what we think are the very best smaller companies opportunities in developed markets as well as faster growing emerging markets. It really should be seen as a vehicle for any client looking for core exposure to the wider smaller companies asset class. The philosophy of the trust is very simple. We take a long-term conservative approach to investing in good quality growing businesses, but we do this in a very opportunistic and contrarian way. We're looking to buy into these higher quality businesses when they are out of favor and they are available at an attractive valuation.
As a sort of follow-up to that initial question, can I ask sort of how you define a smaller company? I suppose these aren't necessarily small companies, are they? But how would you sort of define it in terms of the universe that you're looking at?
Yeah, I think it really differs by region. So, for example, a smaller company in the US is often a mid-cap or even a large cap in other parts of the world. In general, we are limited by the market caps of the largest companies within our local indices. So, for example, at the top end, we don't really buy companies with a market cap greater than $10 billion in North America. But that limit is lower in other regions. So, for example, in the UK, we would buy companies up to about £1.8 billion, which is the top end of the Numis index. At the bottom end of the range, we are really governed by liquidity. So it would be really difficult for us to invest in a North American company below $250 million. And under £100 million is also difficult in the UK market.
Yeah, that makes sense. You obviously replaced a fairly kind of long-standing predecessor recently. So I wonder how, if at all, does your approach differ from that of Peter Ewins, the guy who was in charge before?
Yeah, you're quite right. So Peter ran this trust for 19 years, and I worked really closely with Peter for 16 of those 19 years. And the core philosophy really won't change much. But what will change is that we were acquired by, or our predecessor firm, BMO Global Asset Management in Europe, was acquired by Columbia Threadneedle in November of 2021. We only really combined as two businesses in July of 2023 in terms of physical locations. Columbia Threadneedle is a much bigger organization than we were. They are very intense on research, and there are lots of additional resources available to us as a result of that deal. And we are looking to harness those additional resources. So, for example, in our Japanese equities portfolio, that was previously managed by third-party funds. And what we recognized was that Columbia Threadneedle had a very good Japanese equities team that had a long established track record that was very good and very competitive. So what we decided to do was to internalize 50% of our Japan equities exposure, because the team had a process that was very similar to the way that we managed money in other parts of the trust. And we thought that they would do a good job, and it lowered costs for our clients as well. That has gone really well. The team have delivered a very strong year of performance. So we would be looking to potentially insource the remaining 50%. We are looking also at harnessing other parts of the Columbia Threadneedle network. So, for example, idea generation in North America is another area that we're looking at. We're also looking at potentially some help with picking third-party funds with the use of their multi-manager processes that they have. The shape of the portfolios may change slightly as well, in the sense that over the years, some of the holdings have built up, particularly at the smaller end. So there is an opportunity to rationalize the number of holdings in a pragmatic and gradual way. That's something that we're looking to do.
Sure.
It isn't a secret that the trust sector, the investment trust sector, is under a lot of pressure. Discounts are wide, particularly in small caps. We do think that we have a high quality, undervalued portfolio. So we are increasing our marketing efforts, and we're also increasing the pace of buybacks as well. So in February of this year, we were on a 17% discount, and we were not happy with that situation. So we did increase the intensity of our share repurchase activity. We were buying back about 5% of the company on an annualized basis. And we are now buying back about 10% of the company on an annualized basis. And the discount has come in. We are at around the 10% level. We're still not satisfied. We want to achieve a 5% discount in normal market conditions. So we will keep going until we get there.
Where, you've got this global focus, where in the world and perhaps in what sectors are you seeing the best opportunities at the moment?
We are seeing good opportunities close to home in the UK market.
Sure.
It is pretty well known that over the last 5 years, the UK market has been hit by a lot of outflows. There's been a lot of political uncertainty, and there's been a lack of representation in the in vogue sectors of the market, such as technology. And we think that has created attractive valuations in many UK businesses. Some of these businesses are actually very international in nature. And it is encouraging to see that share buyback activity in the UK market has picked up, as has M&A activity. And that is highlighting that the market is pretty undervalued. So we are finding good opportunities there, and we have a good weighting in the UK. Japan also looks interesting to us, and we are also overweight in Japan. The country is aiming to increase its corporate governance standards. Many Japanese companies are selling non-core businesses. They are eliminating a lot of these cross-holdings that they had, and they are increasing their repurchase activity. And another change in Japan is, of course, the return of inflation. After several years, companies and consumers' mindsets have changed. Wages are rising. And all the businesses that were previously hurt by negative interest rates are now actually coming back into favor. So Japan and in the UK, from a regional perspective, look interesting to us. From a sector perspective, we are seeing a lot of opportunities in the industrial sector, which is a sector which has been in the doldrums for the last couple of years because of destocking, especially after the pandemic, and also because of weak demand, especially in areas such as autos. But over the long term, we are constructive because there are longer term drivers such as automation, energy efficiency, supply chain resilience, and nearshoring. All these things we think will lead to capital spending on industrial equipment, which should help the companies in that sector. Materials is another area where we have a good weighting, particularly in the US. And that's because of growing spending on infrastructure, such as roads and bridges. And that is because of longer term bipartisan funding bills that have been passed. And that should help spending in that sector. And then some of the world's housing markets look depressed, especially if you look at the transaction volumes in some of these markets. And that's largely from higher interest rates. And as interest rates come down, the prospects of the companies within the housing sector should improve.
And how do you manage the risks, potentially greater risks, I suppose, that are associated with smaller companies?
Yeah, I think one of the beauties of smaller companies is that it is a faster growing asset class. But the problem with smaller companies is that it is riskier. And some of the reasons why that is, many of these companies have a less developed business model. The management teams tend to be less experienced, and many of the entities that operate in small cap are subscale, and they are competitively disadvantaged versus larger peers. So our philosophy really helps us to mitigate this smaller company risk because we are focusing on the higher quality companies within small cap that are able to withstand some of these threats. And when we buy into them with a margin of safety. So if our analysis is wrong, then we do have a cushion on the downside that protects us.
And I mean, are there any other kind of key investment criteria that you apply? And how important do you think it is to have kind of a presence on the ground in these markets and be sort of meeting companies? Is that part of the process?
I think it's really important to meet companies because we need to really fully understand the business model before we invest in them. And we need to know where the risks are likely to come from and where the opportunities also will come from. And meetings are an important way as well to form a view on the management team, and particularly to understand the approach to capital allocation, because capital allocation is a important driver of long-term shareholder value creation. So it is crucial that we understand that fully. We generally have very good access to companies, and that's because of the sheer scale of Columbia Threadneedle, the company that I work for. And for example, as a team, we saw over 1,000 companies last year. And this would have been in the UK and also abroad on research trips.
And are there any kind of parts of the world that you won't look at within your sort of global remit?
No, this is very much a one-stop shop for global exposure to the smaller companies asset class. We do cover the whole world in both developed markets and the fastest growing emerging markets.
And you talked a bit obviously about how it hasn't, been a brilliant time for smaller companies. Do you think there is scope now for that to change? The market's been very much led by very large businesses, hasn't it, for the most part? Do you think that might alter going forward?
I think this is a really interesting time to look at the asset class from a number of different standpoints. First of all, if we look at the relative valuations of smaller companies versus larger companies, they are at very low levels, levels that have only been seen a few times in the past. So we do think we are at depressed levels at the moment, and this is in a number of different regions. In the US, smaller companies are undervalued relative to larger companies. In the UK, they are undervalued on a relative basis to their larger peers, but also relative to their own history as well. And that's the same thing in Europe and in Japan. So the valuations do look very attractive for small caps. Secondly, we do think that larger companies will face some challenges from the perspective of many of the businesses, particularly in the US, are now reaching the size where it does become more difficult for them to continue to grow at the same rate that they have been growing. And unfortunately for them, the valuations that they're on, they are not priced for a slowdown in growth. They will inevitably face problems just because of bottlenecks, for example, that will make it more difficult for them to continue to grow at the same rate. And as there is a realization that investors should perhaps not have so much money in these larger companies, we do think that the equity market performance will start to broaden out, and that will be helpful to other parts of the market, including small caps. The other thing that we have noticed is that there has been M&A activity picking up in small caps. For example, we had 7 takeover bids in the last financial year, as there is a realization that many of these companies are undervalued. We do think that M&A activity should continue, and it will be helpful in driving share prices towards intrinsic values. And then finally, we have the prospect of what happens after interest rate cuts. We've had interest rate cuts in the US, in the UK, in Europe. And what is interesting about that is that after there has been the first rate cut, there's often been a change in leadership of the market, because smaller companies historically have been bigger beneficiaries of rate cuts, because more of these companies have floating rate debt, and they have less access to capital. And as a result of that, we have historically seen that after the first rate cut, smaller companies have outperformed by about 10% relative to larger companies in the first 12 months after the first rate cut.
So that was Nish Patel from the Global Smaller Companies Trust. And that's all we've got time for this week. Just to let you know that the Investment Trust show is going to take a break for a while. We'll be back at the start of February with a bumper edition. Please do let us know if there's any particular trusts or fund managers that you'd like us to feature in a future episode. Drop us an email, podcast@ajbell.co.uk. Meanwhile, you can still hear the normal AJ Bell Money and Markets podcast later this week and throughout December. So make sure you tune in for some quality chat about personal finance and investing. Till then, thanks for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.